So let's talk about options. We hear about them all the time, right? These investments that have the potential for these, just massive returns. And a lot of you have asked about them. So today, we're going to break it all down, what they are, the very, very real risks you're looking at, and what actually makes them cost what they do.
Okay, let's just get right into it. You've probably seen those screenshots online of some crazy percentage gains, or you hear traders talking about options, and it gets you thinking, hey, should I be doing that? And you know what? That's a great question. The first step for all of us, though, is to really get the fundamentals down before we even think about jumping in. So, let's start at the absolute beginning. We're going to strip away all the complicated jargon for a minute and just look at what an option contract actually is at its very core.
Okay, this right here, this is the whole game. The key to understanding everything about options is in that phrase, the right but not the obligation. When you buy a stock, that's it, you own it. But buying an option, it's like you're buying a choice. You're buying the power to do something, but you are never, ever forced to do it.
You know, a really good way to think about this is it's like insurance. Imagine you pay a small fee to lock in the price of a house for the next 3 months. If the housing market suddenly goes crazy and that house is worth way more, your contract to buy it at the old, lower price is now incredibly valuable. But if the price drops, you just walk away. You let the contract expire. All you lost was that small fee you paid up front. Well, that fee, that's the premium, and it's the cost of getting that choice.
Now, here's the crucial thing. There are basically 2 main flavors of options. A call option gives you the right to buy something. So you'd buy a call if you're feeling bullish and you think a stock's price is going to go up. Then there's a put option, which gives you the right to sell. You'd buy a put if you're bearish and you think the stock is headed down. Calls for up, puts for down. It's really that simple.
All right, so that all sounds pretty great, right? The potential for big gains, but, and this is a huge but, with that kind of power comes some really significant risk, and we absolutely have to have a reality check about this before we go any further.
And look, these aren't just little footnotes in the fine print. They are absolutely central to how options work. We're talking about the very real possibility of losing your entire investment, fighting a constant battle against the clock, dealing with a level of complexity that can easily trip you up, and the fact that this is definitely not a set it and forget it kind of deal.
Let's be crystal clear about the most fundamental risk. When you buy a call or a put option, the absolute most you can lose is the premium you paid for it. If you're wrong, if your bet doesn't pay off and that option expires worthless, that money is gone. Poof, 100% of it. That's the price you paid for having that choice.
And this gets us to this idea of leverage, which you have to understand. See, a single options contract can control 100 shares of a stock for just a fraction of what it would cost to buy those shares outright. That's how you see those huge percentage gains. But it is a massive double-edged sword. A small price move in the wrong direction can wipe out your entire position just as fast, if not faster.
Okay, so we know what they are and we know they're risky, but what actually determines the price of an option? That premium you have to pay? Well, it's not random. It's actually like a puzzle with a few really key pieces that all fit together.
These 4 things right here are the main ingredients that go into an options price. The stock's current price is sort of the foundation, but it's these other 3, the strike price you choose, how much time is left, and this thing called volatility that make the pricing so incredibly dynamic. So let's take a quick look at those.
First up is the strike price. This is simply the price that's written into your contract, the price where you get the right to either buy or sell the stock. And it just makes sense, right? If a stock is trading at $51, an option to buy it at $50 is obviously going to be worth more than an option to buy it way up at $100. That relationship is totally fundamental.
All right, next, let's talk about what might be the most unique and kind of tricky factor, time. In the world of options, time itself is an asset. An option that expires in a year has so much more time for you to be right compared to one that expires tomorrow. So it costs more. But, and here's the catch, that time value is like a melting ice cube. It's constantly, steadily disappearing every single day. That's what traders call time decay.
And finally, we have volatility. Oh, this is a big one. Think of it as the market's best guess of how much a stock is going to swing around. So if a company's about to announce earnings, everyone expects a big price move. So volatility is high and the options get way more expensive. On the other hand, if it's some sleepy, stable utility company, volatility is low and the options are cheaper. You're basically paying for the potential for a big move.
So to put it all together real simply, if all else is equal, having more time until expiration, that pushes the price up. More expected volatility or more uncertainty,
That pushes the price up. And of course, if the stock starts moving in the direction you bet it would, well, your options value goes up. Understanding how these forces work together is the absolute core of understanding an option's price.
So we've covered the what, the why, and how. Now let's try to put all of this together into a simple, actionable checklist. Think of it as your pre-flight check before you even consider trading an option.
First things first, define your goal. What are you even trying to do here? Are you looking for that lottery ticket growth? Are you trying to protect the stocks you already own? Second, you have to understand the risk and be brutally honest with yourself. Can you afford for this investment to go to zero? Because it absolutely can. Third, get a grip on the pricing. Do you really understand the forces of time and volatility that are going to be working either for you or against you? And finally, please start small. Use paper money in a simulator or an amount that's so small you seriously would not miss it. This is not the place to be learning with your life savings.
And that brings us to the final question, really. At the end of the day, options are just a tool, a very powerful, very complex tool. They can be used for wild speculation, sure, but they can also be used for really sophisticated strategies to protect your portfolio or generate income. The question isn't whether options are good or bad. The real question is whether after understanding all of this, they're the right tool for you and your goals. Thanks for joining me.